Okay, welcome to the Chapter 20, final steps in the accounting cycle for a merchandising corporation. And in Chapter 20, we are going to be going through the conclusion of the accounting fiscal period and its activities. And there's going to be two items left to do in order to close out the fiscal period. The first one is journalizing closing entries, and then the second is posting the closing entries. So if you haven't already done so, please make sure that you have the notes with you so that you can go through and copy down notes and take notes based off of what we discuss here in this presentation lecture, as well as the demo problems, and you can attempt those as we go through as well. So let's go ahead and get started. First thing, in section 1 of 20, the steps that are used in order to journalize the closing entries. In the journalizing of the closing entries, that is closing out of all temporary accounts. After we have journalized them, then we will move on to the posting process. And in the posting process, we will then post these journalized entries and also then indicate in the ledger that all of our temporary accounts have a zero balance, ready to start the next accounting cycle. All right, so transfer balances of temporary accounts to permanent accounts. That is what's going on. So the steps to close the ledger, if we review this back from when we did it for a proprietorship, we want to close the temporary accounts with credit side balances to income summary. We are then going to close the temporary accounts with debit balances to income summary. Remember, income summary is this temporary account that is used as a storage area for funds as we move them around from different accounts. Income summary does not have a balance side, debit or credit. It depends based off of that fiscal period's activities, whether or not the debits were greater than the credits. That determines the income summary's balance side. Then we will close the balance of the income summary to the capital account and then close the withdrawals account to the capital account. That was what we did when we closed in a sole proprietorship. A corporation, a little bit different. Same process, a little bit different counts that are used. Okay, so let's take a look. In our income statement for our corporation, here we have the temporary accounts that need to be closed. So anything that's listed in the income statement column of the worksheet is a temporary account and will need to be closed. So any of the accounts that have credit side balances, they need to be closed out. We debit the account to make it zero, and we temporarily store that in income summary. Then the debit side balance temporary accounts are also going to get closed. And for those, we would credit them to make them zero, which means to make the transaction equal, we would debit income summary. And that's the temporary holding spot for the funds from our temporary accounts before we close them out into our permanent account. All right, so if we take this and apply it in the journal, remember, we always have to label that we have closing entries happening. So in this case, we are going to close all of our debit side balance accounts. So in this one, we are going to debit income summary for $287,379.28, which is the sum of all of our temporary debit side balance accounts. So all of our expenses, including purchases, sales discounts, and sales returns, and even transportation is a temporary account. So we credit all those accounts to make them zero. As we conclude this, then we are going to have a balance in income summary, which is also going to have to be closed out, but it is not closed out to capital as it is in the sole proprietorship. We close it out to our capital account in a corporation known as retained earnings. All right, so let's take a look and putting this into a situation where we have the T accounts. So the income summary now has a credit balance of $32,674.72, which is going to represent the net income. So the closing credit is $323,590. Let me go back. The adjustment to debit is $3,536. This is the amount that was used to adjust our merchandise inventory account. And then the closing debit was $287,379.28. Now, because the credits are greater than the debits, in this case, income summary has a credit side balance. Therefore, in order to close it, we debit income summary for $32,674.72 and credit retained earnings for $32,674.72. All right, here's a general journal. So go ahead and practice demo problem 1. It'll take you through the steps of the closing fiscal period activities, the closing entries for a corporation. Now, the closing entry transfer, if we take a look at this, in this situation, we have the adjusting entry, which is our merchandise inventory debit of $3,612. We have a closing entry debit of $65,178 and a closing credit of $63,790. This indicates that income summary is going to have a debit side balance once the math is done. Once the math is done and we determine that we have a debit side balance in the income summary, we can conclude that we had a net loss for this period. And in order to close income summary, we are going to have to debit retained earnings for the balance of income summary and credit income summary for its balance to close it. All right, so if we take a look at demo problem 2, we are going to take this situation where we have a debit side balance for income summary and then journalize the closing entry in order to make income summary a zero balance. Go ahead and try that. Otherwise, when we get to class next time, we'll be working on it together. All right, so let's go ahead and take a look and just reinforce the main idea here. So as for section 1, using this diagram, we're going to go through the step-by-step process of journalizing a merchandising corporation's closing entries. All right, so what is step 1? What is step 2? What is step 3? And what is step 4? So feel free to go back and review the slides in order to answer that question. But that's what you should be pulling out of this portion of the presentation lecture, is that step-by-step process. All right, now let's take a look at this diagram here. This is a problem that we're going to be working on. This is an independent practice problem. I believe this is problem 20-1. And it's going to take a look at all of the accounts that are listed here and then determining if they are affected by a closing entry, yes or no. During closing, is the account debited or credited or not affected? And then actually all of these, I don't know, some of these will not be affected. And then during closing, is income summary debited or credited? So this is kind of a way of kind of putting everything together to determine which accounts need to be closed and which ones do not. All right, so posting the closing entries, the next step in the process. We label them in the ledger as a closing entry. We indicate the post references to what journal page they came from, and then whatever the journal tells us to do is what we put in the ledger to update the account. And then we use a slash in the accounts to indicate that they have been closed, zeroed out, and are ready for the next accounting cycle. Retained earnings, even though it is affected by a closing entry, it is a permanent account, therefore it does not get zeroed out. So in this case, our retained earnings is going to increase by $32,674.72. Still labeling a closing entry, still taking it from General Journal page 23. Now the income statement's got a lot of stuff going on, always at the end of the month. So the adjusting entry of merchandise inventory indicated here, the closing entry of all of our credit side temporary accounts, and the closing entry of our debit side temporary accounts, and then the closing entry of income summary itself is here. All right, problem 20-3 is going to be posting these transactions. So we have the closing entries up here. Here we have listed sales, purchases, discounts, purchases, returns and allowances, and income summary. This is the closing entry. So go through the demo problem and see if you can see if you can post this transaction to the ledger. And don't forget your post references. All right, after it is complete, after all the closing entries are complete, journalized and posted, then we create a document known as the post-closing trial balance. If you remember, the post-closing trial balance is going to be all of our assets, liabilities, and owner equity accounts. All of our temporary accounts now have been closed and have zero balances. So the post-closing trial balance is going to be a final trial balance at the end of the year, showing that our debit side balance accounts equal our credit side balance accounts. This would conclude then accounting cycle for a merchandise business. We've gone through all of these over the course of the last few chapters, with this being the last step, which is step 9, which is the journalizing and the posting of the closing entries, and then step 10, which is the preparing of the post-closing trial balance. All right, so take a second, do this, see if you can come up with the answer, and this will give you a good indication on whether or not you are understanding what we talked about here in section 2. So do the math. The totals on the post-closing trial balance were assets 156, liabilities 75. I'm sorry, 156,000 for assets, or 75,000 for liabilities. If the ending balance of retained earnings is 45,000, that means what was the capital stock account's ending balance? Remember, capital stock is the other equity account that is used to determine the amount of capital or the amount of equity that is in a corporation. 2 counts now, not just one. In a sole proprietorship, it was the owner's capital account. In a corporation, it is retained earnings and capital stock. All right, problem 20-2. Here is your source document. Again, analyzing a source document and then journalizing it correctly in the cash payments journal. See if you can do that with the information that you have here. Otherwise, we will be going over this in class and working through it together. Problem 20-3, these are the steps of the accounting cycle. We can go back to that slide that we talked about earlier, going through each of the 10 steps. In this situation here, you're just going to revisit them and be able to list what we do first, second, all the way through the end and the closing of the accounting cycle. That concludes the presentation lecture for Chapter 20. Please make sure that you have taken the notes. Go back and review if need be to get the notes in. I will see you next time we meet in class for some guided and independent practice problems.